Hello, investors. My name is Joe Torre. I'm an investment counselor here with Real Wealth. And today we're going to do a short video on why you shouldn't try to time the real estate market. So this is something I come across a lot. I meet investors who are interested in investing, but they never pull the trigger. They're waiting for interest rates to come down. They're waiting for property prices to come down. They're looking for the next hot market, waiting for the perfect time, and then they wind up never investing in property. So in this video, I'm going to try to explain why that's a mistake and that time in the market is more lucrative than trying to time the market. So to illustrate that, we'll go to our friend Warren Buffett. And here's Mr. Buffett and his net worth by age. And you can see that when he started out at age 21, his net worth was $20,000, which is a lot of money in the 50s, but not very much in the grand scheme of things. And his wealth consistently grew. But you notice that at age 65, his net worth was $11 billion, which is pretty good, but it's not the massive fortune that everyone knows him for. 90% of his net worth was acquired after 65, after his retirement age. So his success is partially due to skill as an investor, but largely it's due, his secret is time in the market. He stayed in the game for 70 plus years, from 21 to mid 90s now. If he had retired at 65, you would have never heard of Warren Buffett. He wouldn't be a household name. 11 billion is nothing to sneeze at, but a lot of billionaires retire and you never knew who they are and they're not household names. What made him who he is the fact that he stayed in the game for over 70 years, and time in the market, the compounding and the reinvesting is what caused his wealth to explode. Now, what does this have to do with real estate? Imagine yourself 30 years from now. You own 10 houses free and clear. They're worth $1 million each. You paid only $250 for them back in 2024, but now they've appreciated over 30 years. And since you own them free and clear, they're generating enough rental income to pay all your living expenses. So that's a pretty good place to be 30 years from now. And at that time, when you look back, you're not going to remember if you paid 6% or 7% interest rate. You're not going to remember if you paid $250 for the property or got a deal at $240. All those things are short-term considerations that seem important now, but in the grand scheme of things, 30 years from now, it's trivial. Real estate is a long game. It's a marathon. So you're investing in property today, and whether 6% or 7% or 250 or 240, it doesn't really matter. In the long run, it's going to pan out and you're going to be in a good position. So if you try to time the market and sit on the sidelines waiting for the perfect opportunity, you might wind up sitting on the sidelines for years. In the meantime, you're going to be missing out on rental income, tax write-offs, principal pay down, and appreciation, and also experience, learning how to invest. Opportunities are going to pass you by, and the perfect situation you're waiting for might never happen, or it could take years to happen. And in the meantime, you're missing out. So the idea behind real estate is that you're planting seeds. Most of your returns are going to come from time in the market over 10, 20, 30 years. So today you just want to plant the seed. So all you have to do is put your down payment today, and these wonderful people called tenants are going to pay off the rest of the mortgage for you over time. And your returns will come after you've been in the market for many, many years. It's kind of like the concept of dollar cost averaging in the stock market, where you don't try to time when you're going to buy 100 shares of XYZ company. You just buy 100 shares every month, set aside a certain amount of money. Some months it'll be higher, some months it'll be lower, but over time it averages out and you'll accumulate wealth in the long run. And it kind of works the same way with real estate. So if you don't believe me, just talk to any real estate investor that you know of and who's been investing for a decade or two, and you'll find they all say the same thing. I should have bought more. No matter how many properties they have, they wish they had bought more because they can see the effect of time on long-term wealth creation. So to summarize, start building your wealth today. The old adage is true. Don't wait to buy real estate and wait, and time will be your ally. And time in the market will always outperform timing the market. So if you want to learn more about how to do that, you can get a free membership at realwealth.com. Just go to the website, realwealth.com, click the join for free button. We have a new investor core curriculum, which is 4 15-minute videos that are real short, but they give you everything you need to know to get started. And beyond that, we have a library of over 900 webinars on every aspect of real estate investing. We also have real estate educational webinars every week, every Thursday, and those are posted to the website the following day. And when you're ready, you can speak to an experienced investment counselor and you can ask all your questions and get advice, and it's all for free. So go to realwealth.com and get a free membership and get started. So I hope that helps shed some light on the idea of timing the market versus time in the market. Thanks for watching.